It does not get bigger than this when you have the chairman of State Bank of India on the channel to talk about economy, markets, what is happening at State Bank of India, and which way the credit culture in the country is moving. Mr. Kumar, a pleasure, if I may add, a rare pleasure to have you in ET Now. Thank you for joining us.
Thank you.
Let's talk about the mood point first. The mood point is nobody is using the word boom, nobody is using the word doom, but everybody is using the word gloom. If you have to analyze the economy from your standpoint, especially considering the high frequency data, the retail loan which you're doing, auto sales, how would you map the picture, the big picture?
So as you have rightly said that it's all about the sentiment and the fact that the GDP growth, there is a slowdown. All those numbers, they speak. One is that everything gets measured in relation to the expectation. So in a country like India, our expectation has been built around that we will grow 8% and above. And that is a legitimate aspiration also, because if we have to remove poverty in this country, we need to grow at that pace. And most of the time you get compared with China, which grew faster than 8%, and in a short period of time there has been a remarkable improvement as far as poverty alleviation is concerned in China. And that is where our benchmark is 8% and above. So if the economy in one quarter or in last 6 months, it has slowed down to 5%, it is not meeting that aspiration, and that is where the negativity has come around. If I look at the current environment, there are many positives. One is definitely, of course, after the corporate tax cut, the mood I am finding has suddenly become very upbeat and it has changed. Second is the monsoons, they have been good. They may not have been even, but otherwise the monsoons, when it was delayed, then it was a big cause of worry that are we going into a deficient monsoon situation or are we going in a drought situation. So at least now that is over. Third is we all are in the festival season, so we should all be cheerful and rather be gloomy. So lot of hope on these three things, apart from the fact that many other qualitative measures which government has announced. Almost every week we have some announcement. Some may argue that it should come as a package in one go, but the process which I think has been adopted is about the consultations which Honorable FM is doing with different stakeholders, different industry segments, and based on that what needs to be done is being formulated, being announced, and we should be seeing positive impact of all the announcements made so far, and plus the overall improvement in the environment. What we should also keep in mind that on macro front, the situation is not bad. Your inflation is controlled. Your foreign exchange reserves are more than adequate in my view. Your external debt is very much under control. So in such a scenario, what is and needs to be done, or was something which was some sort of a missing piece, was the private sector investment or private sector capex, which needs to be revived in a way. And with the latest announcement about the corporate tax rate cut, if the business sentiment, which I am finding, has suddenly changed and it has improved, so I am very, very hopeful that the private sector investment in this country will revive.
Before I get into specifics about SBI, what I also wanted to draw your attention to the big picture. Let's assume that we are on course to be a $5 trillion economy by 2024. That's the stated intent. The financial sector will have to do all the heavy lifting. Now, private banks, State Bank of India could start lending at 15-18%, but it will not be 25-30%. Other PSU banks do not have the ability to lend. Private sector will not lend beyond 20-25%. NBFCs do not have money to lend. Where will the credit get created? Who will do all the heavy lifting? Because for economy to grow, you need credit, and somebody has to give credit.
If your economy has to grow at around, say, 8%, at one point of time, the multiple was around 2. And that means 16%. Now the multiple has come down. And my analysis is that why it has come down is that the services sector is growing faster than any other sector in the country. And services sector's consumption of capital is not huge. The capital consumed by manufacturing sector is always huge, very significant. And that's why we are seeing some correction there. Plus, otherwise I think the country or the banking sector has the capability to meet the requirement for credit for growing the GDP at say 8%. There is no shortage of capital, no shortage of liquidity. Even the public sector banks, after the infusion of the capital in the last 2 years, and all these steps which again the government has taken around their functioning, governance, so even PSBs will be in a much more better position to lend. SBI, I don't have any issue. And private sector, most of the banks, they are showing a decent growth. About NBFCs, you will see an improved flow of credit to NBFCs also, because several measures which Reserve Bank of India and government has taken. And now this is time to implement all those. Government announced your partial credit enhancement. Reserve Bank of India gave relaxations around liquidity for when we give loans to NBFCs. They have given relaxation around co-origination with NBFCs, and on lending to NBFCs, lending to NBFCs for on lending to priority sectors, which was not permitted earlier. So in a way, the enablers for flow of credit to NBFCs, all these regulatory steps are something which will enable us to lend more to NBFCs. There are issues around a few NBFCs, but which are solvency related issues, individual entity level issues. And it will be important that those issues are also addressed and sorted out quickly, so that the overall confidence in the NBFC sector, it comes back.
You know, as journalists, we have our ears close to the ground, and the buzz what I picked up earlier this week was that State Bank of India and Yes Bank could be merged. How should one react to this buzz?
It is, I don't know from where these things come. I think this is all imaginary, number one. And if there is any bank, you are talking about Yes Bank, time to time people say J&K Bank, then somebody will name other bank. But the fact of the matter, which I have again clarified several times, one is the State Bank is already too big. And from systematic risk, if you see, nobody would like, as a regulator, as a government, or even if you are in any overseas jurisdiction, 23% market share in deposits and 20% share in loans and advances. So we will do our normal business growth.
So I'm archiving your statement. That State Bank of India will not be merged with any other private bank or PSU bank.
There is like absolutely no case for that. Because as I am saying that from systematic risk perspective also, we should not do that.
Of course.
Even today, public sector banks, after the announcement of merger and consolidation, the next big bank will be 1/3 of State Bank of India. Right now it is 1/4, the second largest bank, and then 1/3. So what we don't need is that State Bank become a 26 or 27%. What we need is we maintain our market share at the current levels, and others grow, become stronger, become more efficient, acquire scale, and be a good competitor in the market. So that will be the what you call a very healthy banking industry. Rather than State Bank, you merge Yes Bank, you merge J&K Bank, you merge XYZ. That is not, I mean, whatever angle you look at it, one is from my risk appetite perspective, I don't have appetite to take over any bank. Second is from a systematic risk perspective, no regulator or government would like to do that. But if still people believe, then what do I do? But nothing of this sort is on the agenda.
No, I appreciate that you've been frank, and this is just going to benefit our viewers and your shareholders also, and all those, rumor mongers on the street, they have got a clear answer. The moot point is tax cut. What my follow-up question on tax cut would be that in FY20, do you think the benefit of tax cut for State Bank of India may not be large because of a deferred tax liability?
That is true. We have deferred tax asset, not deferred tax liability. So first we will have to exhaust that DTA, and then the advantage of corporate tax cut will come to State Bank of India.
But are you in a position to retain the entire tax cut? Do you have that much of confidence and pricing power, or you'll have to eventually align with the market reality?
We are very competitive already in the market. So my biggest problem has been around the credit costs. If you look at it, our operating profit is growing. Our margins are not bad. Only thing is because we have improved our provision coverage ratio starting from 60% to today 79-80%, and the recoveries have not been as per the expectation. So there is a timing difference. I am continuing to provide and provide aggressively, upfronting the provisions in many cases, and the recovery or the money which I have to receive, it is not coming as quickly as we had expected. So I am sitting on a fairly good amount of recovery, but then when it comes, it will be a Diwali for me.
At your last press conference, you said that you're looking up to the God and hoping for recoveries to happen. Has God answered your prayers in this quarter?
It's not an instant noodle. In old times, our Rishi Munis, they used to do tapasya for a very long time before they were given a boon. So it is not that today I pray and tomorrow there will be a recovery in a large account. So I think the recovery process is still slow, and that is where it is a little bit of disappointment. But anyway, what I am hoping when it happens, it may be a jackpot in one quarter.
But are you optimistic or confident that by FY20 you will get resolution on one or two large accounts?
I am confident, but the question is, again it comes to the same thing. Every quarter I have that confidence, and in that quarter it does not happen. But FY20 for sure.
Is Mr. Kumar realistic that in FY20 something will happen?
That is a realistic assessment.
That is a realistic assessment.
Because my largest one account, which is like now, the hearing we are expecting that it will start from 14th of October. Then one account alone is a very large chunk for me as well as for the banking industry in this country.
Markets also got worried when the repo loan pricing got changed. You think that fear is misplaced? Because I looked at your home loan rates. They're pretty competitive. It's not very aggressive actually. So that clearly means that the pressure on your NIMs will not be there.
No, I have several times again stated that our NIM, domestic NIM, is around 3.02 to 3.05. So for us, there is no escape. I mean, there is no scope for reducing the NIM, because the credit cost still is fairly high in our country. So if the credit costs are high, how can we compress the NIM below 3%? It has to be in fact better than what we are currently.
So that fear is misplaced.
That fear is very misplaced.
So when interest rates reverse, right now they're going down, they may go down further next week. But when repo rates will start increasing higher, will you be expanding your NIMs then? Or
we will not be expanding the NIMs.
You will not expanding them.
Because if the repo rate goes up or the interest rate goes up, then the transmission again will happen on both the sides. So depositors also I will pay more.
But deposit growth will come with a lag.
Whatever, but that we take care, as I say. But the interest rate on deposits will be higher, and in the whole process, if the cycle reverses, then this is the risk which we are exposing our home loan borrowers. But that is the regulatory guideline, and we will abide by that.
Okay, your CASA ratio has gone up to 44%. It's an enviable number. But that speaks the power of the brand. In a slowdown, 44% CASA ratio is great. What is happening on the asset side? What is happening on the home loan side? What I've been told is that you are getting incrementally 45 to 50% of the total home loans now. Is it true?
No, that is true. Our market share, if I take ASCVs, right, which is around close to 35%. And if we take housing finance company, then it is around 22%. So we have been able to maintain that market share, and because it comes because of one, the processing capability across the country we have created, price competitiveness, and third is our distribution reach is huge. So that is an advantage of all these three factors.
If I say that this misnomer, which a lot of people have, that government banks are losing market share, it may be true for others, but that's not true for you.
Yeah, that's a fact.
That's a fact.
That's a fact.
How come markets don't talk about it?
Huh?
How come nobody recognizes it?
No, market, I don't think they have ever said that SBI is losing market share. And when you are a incumbent bank, when you have the highest market share, you are the most vulnerable. That is also a fact. And if in deposit I lose market share, it will be by choice. Because if my loan book doesn't grow, then why do I need the deposit at a high cost? So our rates are in fact very competitive again on the deposit side also. And loans and advances, to maintain the market share, we need to do a lot of effort. So that is happening. And corporate side currently is weak. But again, as I said, that we are entering into a busy season. It should also pick up.
One very less appreciated fact, according to me, about SBI is their cost to income ratio. It's constantly declining. That's because new labor workforce is kicking in, pension and other liabilities are changing. What is your guidance there? You don't talk about it. I'm surprised why nobody asks you this question.
Cost to income ratio, our cost to income ratio, the reality is higher than the competition, State Bank of India. Again, there are many reasons for that. But because of various reasons, the provisions for terminal benefits, they have increased quite substantially year on year. Wage division is one reason, plus longevity, other factors, actuarial valuations. So if we keep aside the provisions being made for terminal benefits, then our cost to income ratio is constantly declining. And costs are, we have managed them very well. Our increase in the costs, other than the provisions for the terminal benefits, they are like maybe 3% on an average or this thing. But the income part, one is that the lot of the reversal of interest income when an account gets classified as NPA from a back date, particularly in the agriculture sector, lot of income gets reversed. So what we need to do is keep the expenses where they are, grow our income, and on the provision for the terminal benefits, because it depends upon the actuarial valuations, bank in fact does not have much control about that. So that is the cost structure. But considering that we are such a large bank and is spread across the country, so the CASA which you were talking about, that is an advantage. But managing this size of the bank and the distribution network, the cost structure tends to be higher.
But will it settle down gradually?
No, it is tapering off, as I said.
Where will it settle?
Our aim is 40%. When will I achieve it? It can be like, it will again depend upon the business growth and the income. On the cost side or the overhead side, that control over overheads, plus as you mentioned that the employee profile is changing, we are having more and more new people, so that is an advantage in terms of the cost. But it is an advantage on your current pay, this thing. But as more people retire, your pension liability, it gets impacted.
Will any of the SBI subsidiaries go public before end of this financial year?
SBI cards.
You're confident
We
of
have already
that?
appointed the merchant bankers.
Irrespective of the market levels?
We are getting a very good investor response, and I believe that SBI cards, if the market conditions are very bad, then it is a very different matter. But the indicative valuations which we are getting, we should be able to get those valuations whenever we go to the market. But yes, there is no compulsion on us. There is no sort of a desperation that we have to necessarily do it, but irrespective of the market conditions, there is a very, very positive investor interest. The initial interest is very, very encouraging, and our merchant bankers and everybody is confident that we'll get a good valuation for SBI cards.
And by FY21, general insurance, will it go public?
We will decide, because what we also want to do is that bring a company to a certain level of valuation before you divest. So SBI General, again, if you look at many general insurance companies in terms of profits, break even, it achieved before it was expected. So it is performing better than what a business plan would indicate. And at what stage do we do this divestment or bring it to the market? That has to be a certain minimum level of valuations before we decide to bring it to the market.
If I have to say that, has SBI gone digital? Of course it has, is doing exceedingly well. But how much of a business you would say is digital? How would you classify that?
There are two ways of looking at it. One is the transactions. Now, last year in June, in our the disclosures or the presentation to the analysts, our digital transactions are now 56%. And then we have ATM transactions 29%. So out of 100 transactions, now only 10 are happening at the branch. If you look at our market share in payments, any mode of payment, it will be close anywhere between 20 to 30%. Even for example, debit cards or the spend on debit cards, the share in SBI cards, which is of course a subsidiary. So whichever way you look at it, the bank's market share is higher than its share in the branch network.
Of course.
The share in branch network is 13%.
And bank aggregate is much higher.
Banks, whether digital, share in payment system, transactions, deposit, advances, it is anywhere above 20%. So it means that my employees, business per employee or whatever way
Productivity,
you measure
yes.
it, productivity, whatever measure, or operating profit per employee, they all are very good. Where we are hit always has been the issue around the asset quality and the credit cost.
Credit cost is coming down.
Credit cost is coming down, but again, because the expectation which we had was for a faster, it should have come down at a faster speed.
In next 3 years, will it come down to 40%?
Credit cost?
Yeah, no, cost, in cost income
Maybe
ratio.
22.
22. I was reading a Morgan Stanley report and explicitly talk about the credit cost. And they are of the view that the credit cost will firmly settle in between 150 to about 180. It should settle.
That is high.
That is high.
That is high. In my view, it should settle anywhere between around 1.2 to 1.5%.
So that could take 2 years.
That take, it all depends upon, of course, on the macroeconomic and how do we grow our book.
But the aim is to bring it down there.
But definitely, ideally it should be below 1. But in the market segments we operate, we have a lot of social banking obligations, a lot of things are there. So considering that, it cannot be as low as I would like it to be, but it not be as high as what Morgan Stanley report is saying. And if I would be more than happy if it is around 1%, that is a sort of an ideal situation for us, 1% or below. But if because of the macroeconomic reasons there is a pressure on the asset quality or the credit costs, then but nothing beyond 1.5%. That is what the aim would be.
Over the years I've interacted with you. I guess this perhaps is the most candid interview we've had. So thank you for your time, and thank you for showing me the lighter side of Rajnish Kumar, the banker, and how his day starts and how his day ends. Thank you very much for it.
Thank you.